Welcome back, investors, to Ticker Time News. I'm Adam, and boy, oh boy, has it been a wild ride for Affirm, ticker symbol AFRM, a provider of buy now, pay later services that issued a disappointing Q2 22 earnings report. Now, the anticipation of strong reports, shares were in rally mode throughout most of the day that the earnings were released. That rally kicked into high gear in the afternoon when some of the company's results were mysteriously or mistakenly leaked on Twitter, showing that GMV surged by 218% and revenue jumped by 77% for the quarter. At that point, there was little doubt that the remainder of the earnings report would be strong, especially since Affirm recently locked up an agreement with Amazon. Okay, before we get too far into Affirm's earnings and what the heck went wrong, smash that like button, share this video, and click the first link in the description to get our top 10 stocks list and so much more. Thank you, my friends, for doing that. Now, that assumption that Affirm rocked its earnings proved to be very, very wrong, though. Shortly before the closing bell, investors had the rug pulled out right from under them. When Affirm's full report was released, almost immediately the stock tanked, as there were a few glaring blemishes in the report. Like, the company's guidance was very disappointing on multiple fronts. For Q3, its revenue outlook of $325 to $335 million was merely in line with expectations, and its GMV forecast calls for a 19% quarterly drop. A drop. Due to seasonality, a drop-off in GMV is expected, but this projected decline is significant. For a reference point, GMV fell by 8% on a quarter-over-quarter basis in Q1 of 2021, the same quarter a year ago. Affirm also raised its fiscal year 22 revenue guidance by $60 to $65 million to $1.29 to $1.31 billion, which is pretty weak considering it just exceeded Q2 estimates by $28 million. In essence, the company raised its second half fiscal year 22 revenue guidance by a meager $35 million. And for many companies, any bump in revenue guidance would be seen as a win. But expectations are much, much higher for Affirm, given its landmark partnership with Amazon. Compounding the problem, Affirm sees adjusted operating margin sinking to a loss between 21 and 19% in Q3, and a loss of 14 to 12% in fiscal year 22. This forecast represents a major reversal from fiscal year 21's adjusted operating margin of a gain of 1.6%. During the earnings conference call, Affirm's CFO linked the margin guidance to increasing investments to grow the business. Come on, are you serious? On the topic of profitability, Affirm's GAAP net loss of 57 cents a share missed expectations as total operating expenses soared by 141% year over year. The company doubled its headcount and also ramped up its marketing investments around the holiday season. Rising interest rates are another concern, particularly regarding Affirm's split pay agreement with Shopify, which is expected to comprise 15 to 20% of GMV in fiscal year 22. Specifically, the problem resides in Affirm's revenue less transaction cost metric. During the earnings call, Affirm tried to explain its split pay product with Shopify, saying a 5 to 5.5% merchant's fee, you're not going to make 4 points of margin. And you should expect a little bit of margin compression in the split pay business. The bottom line is that an expensive stock like Affirm, with a mid-teens forward PS prior to this crash, is really vulnerable to a sell-off if the growth projection weakens, especially in our current environment. Well, that's what I think about Affirm's rug pull on us investors. But I want to hear from you. What do you think about Affirm's current problems? And remember, your comments make these videos so much better. Smash that like button, share this video, and click the first link in the description to get our top 10 stocks list and so much more. We've done the research so you don't have to. Thank you so very much for watching, and I will see you in the next video.